Going to go into this evening's topic, which is what is infinite banking? And it took me a while to even want to introduce this as a topic. And when I get into it, you're going to know why. So one of the reasons I created Women and Money Montreal was because back in 2020, at the beginning of the pandemic, there was just a lot of information overload on social media about money and wealth, and this concept is the best thing since sliced bread. And the idea behind Women and Money Montreal is to kind of decipher what all that is and put it into basics. So what is infinite banking? Some of you may or may not have heard of the concept before. Um, so I'm just going to go over the history of it, what it is. Actually, I'm going to break it down into four, actually three topics. First, I'm going to go over the history of the infinite banking concept. Secondly, a breakdown of what infinite banking is, and number three, is infinite banking the right choice for you? So number one, the history of the infinite banking concept. So the infinite banking concept began back in 2008, and it was coined by an economist named Nelson Nash. And he wrote a book called Become Your Own Banker. And the actual concept itself was, I believe, trademarked back in 2000. In any case, what it is, it's just a long-term strategy where you become your own bank. And basically, instead of going to the bank for a loan, you could take out loans against the cash value of a permanent life insurance policy. At the base of it all, it's a life insurance policy that allows for cash value. It is a long-term strategy, and one of the reasons why I wanted to talk about it this evening and address it is because the marketing for infinite banking has just skyrocketed here in Canada. It's been available or it's been around as a concept in the US. And now in Canada, I have a lot of clients who are real estate investors. I know that people who are certified infinite banking representatives, I'm not sure what they call themselves, are approaching real estate investors to really hone in on this concept. And it's really nothing new. What's new is what it's called. So a breakdown of what infinite banking is. Like I mentioned, it's a life insurance policy. So basically, if anyone has ever had or heard of life insurance basically comes in two forms. There's one that's called term life insurance, and term life insurance is pure insurance. It's you have this much life insurance coverage for this amount of time, and if you were to pass away during this amount of time, then your beneficiaries will receive that amount of money. There's no cash value to it. There's no strings attached. There's no bells and whistles. I'm taking out a term 20 policy, so it's life insurance coverage for 20 years. And I chose $500,000 as coverage because those are my needs. If I pass away in the next 20 years, my beneficiary or beneficiaries will receive $500,000. That's it. That's all. After 20 years, for most policies that are available now, you have the option to renew annually to what's called a permanent policy. But we're not going to get, it's not a life insurance session tonight. We're not going to get into that. But that's basically one type of life insurance. The other type is permanent life insurance. And permanent life insurance is part life insurance and part cash. And depending on the type of life insurance you get, that cash could come in many forms. It could come in guaranteed cash values. So if you were to get life insurance today, you would know in 11 years how much cash value you would have in your life insurance policy. There are also policies that have guaranteed and non-guaranteed cash values. So again, in 11 years, you would know how much the guaranteed portion is, and you would have like a guesstimate of what the non-guaranteed portion is. There's also permanent life insurance policy where the cash portion is actually invested, and these are known as universal life insurance policies. Whichever one of these policies you choose or you choose with your advisor, the death benefit is always guaranteed. So your beneficiary will receive whatever the guaranteed death benefit is if you were to pass away, plus whatever cash value has accumulated. So the infinite banking policy concept, what it is it's an overfunded permanent life insurance policy, meaning that you set up the policy so that your cash value grows exponentially depending on what you get. And what you could do, as long as you keep it for a long time, eventually you accumulate a lot of cash value. And whenever you need a loan, instead of going to the bank, you could use that cash value for whatever it is that you need to use it for. This type of permanent life insurance policies have been around for a long time. Now, what's the difference between infinite banking and permanent life insurance? Infinite banking just sounds cooler. So the infinite banking concept was coined back in the early 2000s. And it just sounds a lot cooler than me telling you, hey, Lisa, why don't you check out this overfunded permanent life insurance policy? Essentially, they're the same thing, but what they're marketing is something different, but at the base of it's actually the same thing. Between term insurance and permanent insurance, there's a big cost difference. As a financial advisor, I have a fiduciary duty to not sell you a product. My duty is to offer financial planning. And can infinite banking or a permanent life insurance policy make sense for your situation? It depends from person to person. I have done a lot of permanent life insurance policies like this mainly for corporate clients or for a lot of real estate investors who are trying to plan for future capital gains, but it doesn't start when you're planning on liquidating your assets in 2 years. This is something that has to be planned from a long time ago. And just to give you an idea, the first permanent life insurance policy in Canada was actually created back in 1947, and it was with Canada Life. And Canada Life still exists today. Ironically, it was actually a woman that was insured. Probably the man was paying the premiums, and I'm not going to get into that. But the infinite banking concept is essentially a permanent life insurance policy that has a lot of cash value. And permanent life insurance policies have different variations of cash values. I explained the 3 main ones to you. I also listed them in order of premiums, because obviously with something like universal life insurance, the possibility of making more money and being able to invest in actual investment funds, your potential growth for the cash portion of your policy is a lot higher than, let's say, a permanent life insurance policy that has guaranteed cash values. Anything with guaranteed cash values, yes, it's a little bit of cash, but it's nothing that would make crazy headlines. Or something like the infinite banking concept, I've seen it a lot more. The push is there. I know that they have a strong marketing presence here in Canada, at least for the last couple of years. Number 3, is infinite banking the right choice for you? I'm actually going to show you something. I did this before I came here. And again, it's not about cost. So I'm going to tell you right off the bat, permanent life insurance is more expensive than term life insurance. One is not better than the other. Life insurance is part of a person's financial plan. It's just one element of it. And there's no right or wrong answer if you need it or not. But I wanted to show you what it looks like. Just by show of hands, does anyone here have a permanent life insurance policy? No?
No.
No? Okay. So I'm going to show you what it looks like. And I use myself as an example, except this was based on a healthy 43-year-old woman, and I'm not a healthy 43-year-old woman, but let's pretend for the sake of argument. Hold on one second. Don't save. Sorry, just one second. Okay. Where is my Zoom? Boom. Right. Zoom. Share screen. Okay, so does everybody see my screen? We
Yes.
good? Okay, perfect. So this is the fun and exciting part of life insurance. This is a life insurance illustration, better known as a quote. I used myself as an example, so I added my birthday, which is September 14, 1980. If anybody wants to know, I'm 43 years old, turning 44 this year. And let's pretend the scenario is I heard a couple of weeks ago that the government is going to increase capital gains. I own real estate. And when I sat down with my partner, we kind of guessed, and we gave a guesstimate on how much we're looking at in terms of capital gains that we're going to pay later on down the line. And we've heard of infinite banking, and we heard that this is the best way for us to kind of counter the capital gains. And we want to just see how it looks. So when my partner and I did the calculations, as an example, we figured that I would need $500,000 of coverage, which comes out to an annual premium of almost $9,000. But I'm going to show you the table so that you see what it's like. Oh, did I not do the right one? Okay, maybe I didn't do the right one. Hold on. No, I did do the right one. Okay, so remember I was mentioning there are different types of permanent life insurance and cash values. So this has both guaranteed cash values and non-guaranteed cash values. This isn't the only type. So there are policies where the cash values, even the guaranteed ones, are much higher. Obviously, it's more premiums. I'm just showing you this just so that you could visually see what it kind of looks like, and also so that you could wrap your head around a premium. So I think that this is what's good for me. It's a little less than $9,000 a year. And as you can see, the guaranteed cash value only starts in year 5 of the policy. Again, there are policies where cash value starts right away and it's higher. There are also policies where cash value starts much later, but the premiums are less expensive. So the guaranteed cash value only starts in year 5, and the non-guaranteed cash value starts in year 1, but it's nothing crazy. But as you can see, as the time goes on and I pay into the policy, the cash values increase. And that's just to give you kind of like an idea of what it visually looks like. Is this an example of the infinite banking concept? Yes, it is, because again, like I said, the infinite banking concept, what it is a permanent life insurance policy that pays a cash value. So this is what it looks like. So let's say, same scenario, I need $500,000 of coverage, but you know what? Like that policy that I just showed to you, I have to pay it for life. And, I don't want to pay this thing for life. I'm 43 years old. I want to retire at 60. I want to pay it over 20 years. So I'm going to show it to you here. Hold on. So I'm going to pay it over 20 years, and it kind of aligns with when my mortgages are supposed to end. So now all of a sudden, same coverage, but my annual premium has shot up to $15,000 because I'm paying this over 20 years instead of paying it for life. And if I look at the cash values, again, the guaranteed starts in year 5, but the non-guaranteed cash values start in year 1. What the non-guaranteed cash values are, it's basically insurance companies, they take your premiums and they invest them. And at the end of the year, what they do is they kind of distribute them to all their customers. So it's not directly like dividends that you would think of in the investment world, like through DRIP, for example, if anyone has a DRIP through their investments. But they're safer, they're more stable than actual investments in the investment world. So insurance companies in Canada will pay out a dividend. It's just that the percentage is not guaranteed, and they're not allowed to say that they're guaranteed. But in general, insurance companies will pay at least a 5% non-guaranteed cash value every year. Again, is it guaranteed? No, but that's been the trend, at least the 5%. So this is just an example of if I have a situation where I have properties and I want to offset the future capital gains. And when I do the calculations, this is what works for my situation. I don't want to pay this forever for the rest of my life. I'd like to pay it off in 20 years. So instead of the first quote that I showed you, which was about $9,000 a year, this is $15,000 a year for that benefit of paying it off in 20 years, so that I'm not paying it, throughout my retirement. So it boils down to, is this solution, does it fit into your overall financial plan? What the infinite banking concept marketers and social media have also said, they promote it as being your own banker, and instead of going into debt or taking out a loan at the bank, why don't you use this to pay off your debts? Well, the thing is, it doesn't start right away. Like, as you saw, the cash values do not start right away. So unless like your debt is only $3,000, like let's say $3,000 of credit card debt, are you willing to pay this premium for a few years in order to pay it off? It doesn't start right away. It's a long-term strategy. And if you guys have, if you've ever attended one of my previous Zoom sessions, which is life insurance for children, it's actually a popular concept for parents with their children, because when your children are young, ideally, you open an RESP for them, a registered education savings plan for them. And a lot of parents ask me, what else could I do for them? Something like this works. But fiduciary duty, like I mentioned, like I have to act in the best interest of my clients. If you're coming to me and saying, listen, I want to get a life insurance policy for my child, that's great. I could help you with that. But I'm also going to ask you as the parent if you have life insurance. And it's funny because parents ask me why. And I'm like, well, because you're the ones who are paying the premiums and you're the ones who provide a life for your child. And life insurance at its basic is to cover it's to cover an income that's no longer there, or to the presence of someone who's no longer there if you were to pass away. And like, our children are important, but even more important are us, because we're the ones who provide that life for our children. But I'll tell you, in the industry, are there advisors who will go ahead and issue a life insurance policy for a child and not even check to see if parents are insured? Of course, because it's a sale. I wouldn't do that. I wouldn't do that because it doesn't make sense for your financial plan. So I always look over the entire financial plan. This is something that a lot of real estate investors do. But again, it's, don't contact me and say, hey, this is what I want right away. I have to look at the whole, at your whole situation. Do you have any liquid cash? Do you have any other ways of putting money aside? It's just one part. It could be one part of your financial plan, and if it's right for you, it depends. Okay, so it's not something that I could answer. I think that's it for on my end. I'll open it up to you all. Are there any questions on infinite banking or